Hey everyone, Ben here and welcome to Motivation to Invest. How do we value a stock? This is a question I always get asked on this channel. Ben, how do you actually value a stock? And to be honest, it is quite difficult to value a stock. Some companies are easier to value, such as more established, free cash flow generating companies, but valuing a young growth company with lots of future potential can be extremely difficult. So in this video, I'm going to break it all down into exactly how to value a company in a really simple way. And I'm also going to discuss the relationship between the share price of a company and the company's earnings or profits. So this is going to be a really interesting video, guys, and I think it will really lay the foundations if you want to become an exceptional investor. So before we dive right in, if you're new around here, feel free to join the investing family by hitting that subscribe button and turning that notification bell on. And if you do find any value at all in this video, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. That being said, let's dive in. So firstly, what is the value of a stock? Well, let's just change our wording slightly. Instead of saying stock, let's say company or business, because all a stock is a portion of a business, and we need to constantly remind ourselves of that. So the value of a business is the value today of the company's expected future cash flows. Now, to break this down really simply, here's a simple slide here. I've put this presentation together. So it's the value today of the company's expected future cash flows. And to make that simple for you guys, would you prefer $1 today or $1 next year? If I offered you now, here's $1 now, or do you want this $1 next year? Obviously, you'd say you want the dollar now. But what if I said, would you prefer $1 now or $10 next year? But that's potential. So I could give you $10 next year, but there are some risks which come with that. So it's not definite, but there is a possibility that I could give you $10 next year. Which would you choose? And this is the question we're trying to answer when valuing a company. We can see plenty of companies which offer us the dollar today, but we also see many growth companies which offer us $10, $100, $1,000, $10,000 in the future. And our goal is to figure out the likelihood of the company actually receiving and us shareholders actually receiving a portion of that extra revenue. So this is why we discount cash flows back from the future to today's present value. And this is not a new philosophy. I believe an ancient Greek philosopher came up with the phrase, a bird in the hand is worth two in the bush. And it's pretty simple, really. Of course, a bird in the hand is worth two in the bush. And the questions we're trying to answer is, how many birds are in that bush? What's the likelihood of there being birds in that bush? And what is the value of the bird in our hand and the birds in the bush? Now, I recently read a book on Warren Buffett's shareholder letters, and he explained this principle of a bird in the hand versus a bird in the bush. And he explained it with dating. So basically, imagine you've got in your phone plenty of contacts for people you could potentially meet up with, or you've got someone sitting right in front of you on a date. Which is more valuable? Well, of course, the person right in front of you is more valuable. And this is basically what Warren Buffett said. Warren Buffett also made another interesting joke. He said in the case of the dot-com bubble in the late 90s, he actually stated that there were no birds in the bush for many of these internet companies. So many companies were going public with just internet in their name, no real business model, no real sort of cash flow generating opportunities for the business. And of course, there were no real birds in the bush for many of those internet companies, despite the internet being amazing transformational technology, which definitely did change the world. So that just shows how difficult it can be to spot the winners during these crazy bubbles, because every bubble starts with a nugget of truth. And then we go on to growth stocks or young growth stocks or young companies. So what really categorizes a growth stock? Well, usually the price of the growth stock and the current value put on that growth stock is usually based upon a lot of future expectations for the company. Now, this can also lead to a lot of risks, and also if a stock is priced for perfection, any bad news in the immediate term could cause the stock to plummet a lot easier than a real value play. But then on the upside, you do get that extra growth potential. In the words of the legendary investor Howard Marks, the choice isn't between value and growth. The choice is between, do you want value today or value tomorrow? And basically he says, as it's so difficult to predict the future, there's a famous quote, predictions are very difficult, especially those about the future. So basically a lot of pure play value investors don't bother looking at a lot of growth companies because they just find it too difficult to actually value these companies. In the words of the great investor Charlie Munger, they put that on the too hard pile and focus on the easy stuff. Now that's all well and good, but in this modern world we live in, I think we can't just ignore growth companies because we would have missed out on Amazon, Google, Facebook, all these incredible companies when they were coming up, even Tesla recently, Peloton, Etsy, many, many more stocks which I'd recommended on this channel. So we have to think about things logically, and we have to still look at growth companies and look at the future growth potential, but we also need to take into account the extra risks. That's what I personally think. I think we can't just ignore growth companies and say, oh, let's just focus on pure play, mature, free cash flow generating businesses. That is one method, but I think we're missing out on some major potential opportunities. But having said that, I want to dive into a real value metric, and that is the relationship between the price of the stock and the company's cash flow, or even the company's earnings. So as you can see here, this is looking at the price to earnings ratio, and it shows it predicts future stock returns. So as you can see here, back in the 1980s, if you invest into stocks which had a low price to earnings ratio, which is the stock price divided by the company's earnings or profits. So generally, if the stock has a low price to earnings ratio relative to its industry, then you could say the stock is undervalued relative to its industry. But this isn't really valuation, it's more pricing. But it's still interesting to look at. So as you can see, you're back in the 1980s. If you would have bought all the low price to earnings value stocks, you would have found that your forward-looking 7-year return was much, much higher than if you'd purchased the higher stock. So as you can see here, buy low and the stock price high. If you bought high here, so this was the dot-com bubble, you bought the highly valued price to earnings ratio stocks here, then you would have found lower returns. So that's basically simple correlation. It's still interesting to remind ourselves that historically, buying the cheapest stocks in the market according to price to earnings ratio has resulted in better returns. And to show you how historic this trend is, here's a line relationship between price and earnings from 1930s. So from the 1930s, you can see here, this looks at surplus earnings adjusted for dividends, and you can see the line of the relationship is linear. So basically, as the earnings of the company increases, you can also expect the stock price to increase. And this makes complete sense. If a company's making more money, then it's bound to have its share price increase also. So how can we use this to identify potential buying opportunities? Well, I'm here on Guru Focus. There's a link in the description below for this software. And what I've done is plotted the share price of Amazon against the earnings per share with analyst estimates. And the idea here, we can say, okay, if the share price is ever trading at below the earnings line, the earnings per share line, then that can be a potential buying opportunity. So diving in here, we can say if we go back to 2015 and we have the share price, which is the light blue line here, and the earnings per share is above that, if we bought here, we would have definitely made fantastic returns on Amazon up to this point here. And this is actually when I first actually bought Amazon, around this point here. So the method does work. It's not an exact science. There's many details you can go into with true valuation, but it's definitely interesting to look at. Would it have worked in 2020 crash? No, it wouldn't have. So as we can see here, and the share price did drop, but it didn't drop below this earnings line. So it wouldn't have worked on that point. So what about Etsy? Let's find out with Etsy. So if we dive into Etsy here, this is another stock which I bought in the March 2020 crash, and the position is up around 300% right now. So that was a great investment. And as you can see here, if we plotted the earnings per share line, which I did at the time, and we can see Etsy's share price was below the earnings per share line. So I can see the trajectory of the earnings for this company actually increasing in a linear manner. And the share price has actually dropped much lower. So I can see here, this gap here is a potential margin of safety. So that's when I invest into the company. It's a very simplistic way of doing valuation, but it works. And up to this point here, but now it's obviously a lot over the earnings line. The earnings are starting to sort of level out. So then we could expect to see the stock price level out in the future and maybe move sideways for a period of time. So we'll see what happens there. Of course, the company might be focusing more on revenue growth. So you could also plot revenue on here. An interesting company I've been trying to value at the moment is a data company which does data monitoring. They've got customers such as Amazon, Microsoft, Google. The company's called Datadog. It seems to have a very high valuation. I've been trying to categorize what the true value of this company is because it's a growth company. They've had fantastic growth over the past few years, around, I believe, between 60 and 80% growth. Now, to put that in perspective, generally, I say growth stock is one growing between 15 and 20% per year. And as we can see here, the share price now, there's been a recent correction with regards to interest rates have caused the stock market to fall. And the share price now is below this revenue estimate line, which is projected to actually increase in a linear manner. We can't use earnings for Datadog because the company is still unprofitable, but this could be also a potential buying opportunity. But I've also created a full valuation spreadsheet. So this is a really advanced video, guys. I've shown you this before. If you check out my previous video on my Tesla valuation, Amazon valuation, I believe I covered Google, Facebook. This spreadsheet is available to download for free in the VIP group. I'll leave a link for that VIP group in the description below, and you'll also get access to my buy and sell signals and my entire investment portfolio. So diving in here, what I've got is a variety of scenarios. So I'm looking at average case for the company, which I expect, best case and worst case. And what you can basically do is plug in numbers for revenues, cash flow, earnings for the company, and play around with these different numbers. Look at the different growth rates. You can use analyst estimates for growth rates or come up with your own growth rates in order to figure out the potential fair value of the stock. So when the stock price drops below that fair value, you know that is a buying opportunity. So valuation is not an exact science. It's more of an art or a craft. The more valuations you do, the better you become at valuing companies. And every company can be different and can be in different industries. What I've done here, I've plugged in revenues because the company isn't profitable. It's best to use probably cash flow, followed by earnings, and then followed by revenues. So they currently had in 2020 around $600 million in revenue. So I've plugged that in here as 0.6. And then I've extrapolated that out. It's a 40% growth rate expected for the next 5 years. Now, that's quite conservative. The last year, they grew at 56%. Previous years, they grew at 80%. The next 5 to 10 years, I've dropped that down to 30% growth rate. And then I'll get into why I've used this high discount rate. Usually, you'd use a discount rate at around 10% because that's your expected return. The terminal multiple, you could use a price to sales, price to earnings multiple, 26 there. So what I've done is, the reason I put this really high discount rate here at 30%, usually you'd use about 10%, is basically, as we're using revenues, I've put this high discount rate to try and scale it to profits. It's not really an exact way of doing it, but when I did this, I just found the numbers seemed closer to the actual market value. So to me, it looked a little bit more accurate for this particular company. So what I've done here, I've plugged in my numbers, I've plugged in expected growth rate. So for the best case scenario, I'm expecting 50% growth for the next 5 years. For my worst case, I'm expecting 30% growth rate for the next 5 years. And you can look at all sorts of factors which will impact these growth rates. So you can look at analyst estimates, you can look at competition in the industry, you can look at if the company has a competitive advantage. So what this does is weigh up the different scenarios in terms of probabilities, and you can input the probabilities. And then basically it gives me the fair value per share of Datadog today of $92 per share. What is the stock trading at? Well, let's find out. So Datadog share price. This will show you how accurate we are. So the share price today is $95 per share. So this currently says the fair value of the stock is $92 per share. So it's currently, we could say, at fair value. Now, this is one method of valuing the company. I value the company also using this advanced spreadsheet. Now, this one's really advanced. There's like 20 different pages on this. And this is a really advanced spreadsheet from a valuation professor at New York University. So I'm currently going for the valuation on that at the moment. It seems like the company's worth a lot less using this valuation. So really the goal of this video is to show there's many different ways of valuing companies, but really it's about understanding the company, understanding the fundamentals of the business, and basically answering the simple question: how much cash flows do you expect that company to produce in the future? And then compare that to the price the company is today. And it's really as simple as that. So all these spreadsheets are available for download in the VIP group. If you guys did find some value in this video, feel free to give it a big thumbs up. It helps out tremendously with the YouTube AI. If you're new around here and you still haven't subscribed, feel free to join the investing family by hitting that subscribe button and turning that notification bell on. And with that being said, thank you guys so much for watching. I hope you have an incredible day, and I'll see you in my next video. Invest safe.